Okay, so good afternoon, everybody. I hope you are all doing very well. Welcome to this webinar with FX Street, where, as I said, the topic is going to be how you can generate a 74% win rate with an easy-to-follow FX strategy. Now, this strategy is one that I've been using for a little while. There have been various different incarnations, but it is generally the approach that I follow in the markets. And 74% win rate is what we were able to achieve last year. Over the course of about a decade or so, it's actually closer to 71%, but last year the markets moved quite well. And that's where we currently sit on a rolling 12-month basis. So I hope you're all excited to watch this webinar. I promise you that this is something where if you start to implement it, and as soon as you start to implement it, you will start to see results, okay? And as I said, it's not going to take too much in terms of being able to read price patterns and things like that. I know there are a lot of very successful strategies out there that require a lot of subjectivity, but with this particular approach and, with my experience of working with my community and my traders, I've found that, we need to find a balance. So whereas you might find something that's a little bit more profitable if you have that, that gift for trading, let's say if you've had the hours and the years in the market to be able to learn to recognize price action, that may all be well and good, but actually one of the first things I like to do with my traders is that I like to get them to a point where they're making money from the markets. All right, that's absolutely the first thing. It may not be the most profitable, so you're not going to, do 50, 60, 100% every single month with this particular strategy. But when the markets move with you, okay, and this strategy will help you wait for those moments in time, then you can get to a point where you're doing double and sometimes even triple digit returns on an annual basis. Now, this is a swing trading strategy, so we will be looking at the daily charts. So some of you, that may be something where you feel like you won't get enough opportunities, but please bear with me because there is a little bit of a sort of like a twist to this particular approach, which allows you to be in the markets fairly frequently, almost as much as you would be if you were trading something shorter like the 1 hour or the 4 hour chart. Okay. And the reason that we use the daily chart, all right, so let's kind of talk about that. The reason that we use that is that it has been proven that the data suggests that, traders are far more successful the longer the time horizon they're looking at their trades. Okay. And there was actually a study done a number of years ago with a broker where they looked at all of their clients, and they found that typically speaking, and there were a few outliers there, but typically speaking, the further out you went in time. So if a trader was holding his trade for 15 minutes versus one that was holding it for, an hour versus the one that held it for days and weeks and so on and so forth, the longer the time horizon, so the further you went out in terms of the general holding time of a trade, which indicates what charting, what time frames they were utilizing. So the longer term approach tended to win out. So those traders were more profitable. And as I said, my whole thing with trading with my community is I want to get them to a point where they're making money. All right. Yes, it may not be where you're going to take $1,000 or £1,000. You're going to turn it into $100,000 or pounds over the course of the year. But you know what? It's one where you can generate consistent returns. And then you look at other ways of growing your account. So once you know that you can generate, 50 to 100% a year, then you look at ways of putting more money into your account, whether that be through a funded trader program, whether that be through savings or whatever. Far too many people come to these markets and their idea is that they put a little amount in and then they very quickly trade it up to a point where, they're making, tens of thousands, hundreds of thousands every single month from their trading. And whilst you may have heard a few stories like that, maybe you've read a Market Wizards book or you read it on a forum or something like that, they're very few and far between. And what you'll find is that particularly if you look at some of the Market Wizards, sorry, my throat's very, very sort of sore today, so bear with me if I have to cough and clear my throat a few times. But what you'll find when you read some of these books is that, hopefully I can speak now, is that a lot of these traders, that they did start out with a fair amount of capital behind them. All right, so they didn't take $500 or $1,000 and they didn't trade it into $1 million. So what we're going to do today is I'm going to teach you an approach, as I said, where you're going to be able to utilize it as soon as next week. So it's a very, very simple approach to the markets, but it's very effective. In fact, last year it generated 200% return trading just the major FX pairs. So that's the Aussie dollar, Euro dollar, pound dollar, New Zealand dollar, dollar CAD, dollar franc, and dollar yen. And I know that there's a lot of dollars in there, but they're the major currency pairs. So 200% just trading those seven. And you weren't trading every single day. Okay, there were times, there were days, there were weeks where you had to sit on your hands. But thankfully, the way that we've structured this approach, it's quite clear when you should be sitting on your hands. And that sort of brings me to one of the primary parts of this strategy that make it so effective. And that's the fact that we need to develop a directional bias. So if you've been trading for a little while, you may have fallen into the trap of, if you look at this chart, we've got the euro dollar here, okay? You may have fallen into the trap where you see that the market is selling off over here and you think, I want to be a seller. So you start selling. Perfect. And then you start to see some momentum come into the market and you to the upside and you think, I want to be a buyer. Then you become a buyer. And then sure enough, the market turns around and you would have been stopped out of your buy positions and then you become a seller again. So you've made money here, you've lost money here. You've made money on this downwards move, and you've lost money on this pullback. You make money on the downward move. And the common theme there is that you're making money when there's momentum in the market in the direction of the longer term trend. And so what we need to do is we need to put ourselves in a position where we're able to identify what that direction is beforehand so that we can eliminate these opportunities over here when the markets are going against us. Okay, so we want to put ourselves in a position where we're trading with a longer term view on where the markets are going to go. All right. And that's one of the keys, right? That's something that I've found once I've taught my traders, I've taught my community. One of the biggest things that sort of like impacts their overall trading and their success is the ability to take a step back and to choose a direction in the markets. And once they have a direction, then be committed to trading only in that direction. So don't be seduced into taking some of these opportunities that are, the pullbacks in the markets, because there will be some, absolutely there will. And there will be opportunities to make money. But what will happen is that, you might get, when you're trading, if you were selling this market as the market's moving down, you might find yourself with a 75, 76, 74% win rate as you're trading with the trend. But then when it goes against you, you're more like a 55% or something. So you're mildly profitable there. All right. You're just kind of on the cusp, almost break even, making a little bit of money, but it brings down your overall profitability. And what that does, well, it doesn't bring down the profitability. Sorry, that's the wrong way of putting it. It makes it more challenging for you to trade. So whilst you may be making money there, what happens is as a retail trader, you find it harder to trade that system because instead of being right 7, 8 times out of 10, now you're finding yourself where when you combine it all, you're right 5, 6 times out of 10. So nearly half of your trades, not quite half, but almost half, are starting to lose you money. And the way that the win-loss distribution takes place with trading is it isn't evenly distributed. So if you have a 70% or 60% win rate, you're not going to, take 2 trades or take 3 trades, win 2, lose 1, and then sort of continue that sort of pattern. It might be that you take 20 trades and all 20 lose you money. And then you take another 10 and then they lose you money. And then you take 70 trades and all of them make you money. That's the way that it works. I know that it sounds weird, and for some of you it's hard to get your head around, but that is a really important concept that you all should understand, because it genuinely makes a difference to your trading. Once you understand that the distribution is completely random, it's only over a large sample size full of trades that you'll be able to see your edge play out. You'll be able to take your losses that little bit better. But other things that we can do, yes, absolutely. And one of the things that we can do is that we can say, well, we're going to take a directional bias. We're going to take a directional view, and we're going to look to trade with a strategy that has a high win rate, because even though I know that the distribution of wins and losses are going to be random, You know, if I'm at an 80% win rate, for example, as opposed to a 60% win rate, you know, the distance between my wins and losses is not going to be as great. So, you know, my drawdowns, in theory, it could, you know, go into days, weeks, even months even. But if you have a higher win rate, that probability comes down. Does everybody follow that? If you just type a yes or a no into the chat box or the Q&A box, just so I can see that we're all on the same page and you all know what I'm talking about here. Yeah? Okay, perfect. So then the question is, well, how do we develop a directional bias? I don't have the time in this particular webinar to go into detail of how you read fundamentals. I will talk to you briefly about it, and then I'm going to give you a technical way of finding your directional bias, okay? But what I would like you all to do is take some notes about what I'm going to say, and then go and do some research around it, because I promise you, this is the most powerful way to develop a directional bias. And that's by keeping your finger on the pulse of what's going on in the various economies that you're trading. So here we have the euro dollar. So what I want to do there is, and I say economy, but really you want to be paying attention to what the central banks are saying and what they're doing in terms of their interest rate policy. So are they hiking interest rates or are they cutting interest rates? Because what tends to drive the direction of the markets in the medium to long term, okay, is the interest rate differentials between the two countries' economies, the two currencies that you're trading, and not just the differential right now, but the expectation of where that's going to be. So for example, last year, all right, if we go back to the beginning of 2022, so all of this period over here, was there a way for us to predict this downwards movement? And the answer was absolutely there was, because what happened at this particular point in time, all right, we had in Europe, we had the fact that the Ukraine war broke out, so the war in Ukraine, so that was obviously going to weigh on the euro. But at the same time, and perhaps more importantly, we had the fact that the Federal Reserve were hiking interest rates, and we're talking about being very aggressive with their interest rate hikes. The war in Ukraine also pushed energy prices up, which pushed inflation up, which, you know, and when we looked at the ECB, they were a little bit behind the curve there. So, you know, they had to worry about inflation, and price stability is their primary mandate, absolutely. But they did have the war in Ukraine to worry about at the same time, whereas the Federal Reserve were a little bit insulated from that. So they had they were able to act a little bit more aggressively. So throughout the let's say the first half of last year, really the expectations were that the interest rate differential was going to, be on the side of the US dollar. So we're going to see the US dollar strengthen, okay? And this isn't something that I guessed, by the way. This is something where, you can find this information very, very easily. You literally just have to go to the various central bank websites. They will tell you what their primary and secondary mandate is. You'll also be able to get the minutes of their last meeting. So they will tell you, yes, we're looking to raise interest rates. We plan on doing, 50 basis point hike at the next meeting, followed by, maybe another 25 basis. And they may not be as clear as that, but they'll certainly hint to that. They will say things like inflation is still high. So they're going to maintain sort of like a hawkish stance. They're going to combat inflation. They're going to, attempt to do things to push inflation down, which essentially is raising interest rates. Now, once inflation comes down, okay, then you get to a stage where the central banks will want to sort of like kickstart their economy. And that's when they'll start to cut interest rates. And what happens there is that you see a flow of capital go out of that particular currency into another currency. All right. And what can happen at the same time is that you may get something like what happened over here, is that the markets back in September of October last year started to price in the fact that the Federal Reserve had come to the end of their rate hike cycle, and perhaps they would start to cut interest rates. And at the same time, you had the ECB was still because they were behind the curve there. They were in the midst of their rate hike cycle. So the expectation was that the differential between the two currencies there was going to narrow and then potentially even start to move to the side of the euro, which is why we saw this appreciate over here. So looking at the fundamentals, and you don't need to look at everything, okay? You just need to look at the things that are going to affect interest rates, which essentially is the health of the economy, employment, and inflation. All right, they're the things that are going to affect monetary policy. And if you can stay on top of that, then you'll be in a position where you'll be able to stay on top of the markets, and you'll be able to make money, pick a direction in the long term. Does everybody follow that? Does that make sense? Now, I know that's very complicated, and it's not something that you can just teach in 15 minutes. So what I need to do is I need to give you a more straightforward way of doing that. Okay, now this isn't going to be as powerful because we're going to use indicators to do it. And what that means is that our direction, we might be lagging a little bit. Okay, because whereas when we're looking at fundamentals, we can be very, very forward looking. If we're looking at technicals, even at price action, you've got to wait for levels to be broken and things like that. So for example, if we were to go over here, we could have picked the fact that the market was going to sell off in January of last year, even though it hadn't actually started to sell off. With indicators, we need to wait to see that happen to confirm our directional view. So this is where you're going to need a pen and paper. The first thing we want to do is we want to develop our directional bias. And the way that we can do this, a very well and widely used moving average, is a 200 period moving average, okay? And what we generally say is that, and this isn't just myself, this is professional traders throughout the world, okay? What we say is that when the market is above the 200 period moving average, then the overall trend, okay, is going to be to the upside. When the market is below the 200 period moving average, then we'll say the trend in the overall direction is going to be to the downside. So we're expecting the market to sell off. All right. Now, just with this moving average, you can be very, very successful trading. Very, very successful, because you can literally say, well, while we're below this level, I'm looking for sell opportunities. And then you insert your favorite strategy. Then I'm going to give you a strategy here in this webinar, but I'm just trying to demonstrate, illustrate how easy it is once you have a directional bias, because now suddenly you're not worried about all of these little pullbacks. You're not trying to buy into these pullbacks. Instead, what you're doing is you're looking at these pullbacks as an opportunity to get into the market, because we know the markets, they don't move in a straight line. They don't move like that. Okay. It's not what happens, or like this, for example. That's not what happens. What happens is the markets ebb and they flow. So they'll move down a little bit. They'll move up a little bit. They'll move down, they'll move up, they'll move down, they'll move up, and so on and so forth. Why does the market move up? Are these periods here, the buyers taking control of the market? Is this a reversal? No. We have a directional bias. We believe the markets are going to sell off. So what is this that we're looking at over here? Well, this particular period in time, okay, is profit taking in the market. This period of time over here are all of these sellers. If you imagine when you're in a position, at some point in time, you want to book profits, right? You don't want to hold it forever and ever and ever. So what you do is you say, well, I've just made money in all of this move. I'm going to come out of this position. And then when the market starts moving down again, I'm going to sell into it again. So what happens if you get out of a sell position? How do you get out of a sell position? You have to buy the markets, right? You have to become a buyer. And this is things that you've got to think about. And there are very few sort of retail traders or home-based traders that think about trading on this level. But I promise you, once you can get into the psychology of the market, it will help you significantly. So the moving average, Hassan, is the 200 period moving average, right? So what happens is they want to buy the market. When you become a buyer, it's going to create demand for a currency. It's going to push the value up, or at least sideways. All right. Then what you do is you wait for the next opportunity for the market to move down, and you sell into that. Now, this is still quite subjective. All right. Where do you sell? Where's the end of the pullback? Still quite subjective. I completely get that. So what you can do is you can insert a shorter term moving average. And what this does for you, okay, is it allows you to gauge when there's momentum in the market. What you want to do as a trader is that you want to trade in the direction of the longer term trend when the momentum in the market is with you. So you're not interested in trading these little pullbacks over here. Okay. We're not interested in trying to sell into this. Once the market is below and sold below the moving average, then we can sell. All right. We don't want to get involved in those pullbacks. So what we do is we have a longer term moving average, 200, and we have the 20 period moving average. And between the two of them, you then put yourself in a position where it's very, very easy to pick where to get involved in the markets. Essentially, if the price is below the 200 period moving average, the market is moving down. So whilst price is below the 200 period moving average, you're looking for ways to get into the market. You want to understand when is momentum with my trade. And the way that we identify that is we use the 20 period moving average and we say, well, when price is below the 20 period moving average, then I want to be a seller. But I only want to be a seller if price is below the 20 period moving average and price is also below the 200 period moving average. So it's not a question of just buying when you're above the 20 and sell when you're below the 20. It's sell below the 20 when price is below the 200, or buy when the market is above the 20 when the price is also above the 200. Do you see what I mean? And then what happens is that where traders, they lose money in these areas over here. This is where they end up losing money, trying to buy the market. You're not losing money there. You're simply waiting for your opportunity where the market will start to sell off again, and then you get involved in the trade. Now, here's the really special part. Okay, here's something that I don't know anybody really that trades this way in the market. And this is because they've just got a fundamental lack of understanding as to how the currency markets work. So what they do is that they will typically wait for these pullbacks. So they're sort of where they will look to get involved in the markets is like here, that will be a sell, that will be a sell there. There might be one there. So when they're at the sort of like the end of the pullback, that's the ideal place to get involved in the markets. Here's the problem with that. It's not unprofitable, but the volume of trades that you would have will be very low, which means that the amount of time you'd have to wait to see your edge play out will be a long period of time. All right, let's look at this. You've got the 1st of April over here, sorry. 1st of April, the next opportunity would have been the 3rd of June. Then after that, we're going towards the end of June. And then after that, you've got to wait all through July. And then eventually in the middle of August, you'll get an opportunity. And then later on, you get one in September. You see what I mean? So you kind of get, they are valid and you would still trade these. But what we also do as traders, and what I teach my community to do, is to trade the move within the move. Okay, so to look at the price action of the individual candles in the context of the rest of the chart and look for opportunities there. So in this opportunity here, where the market sold off, you would have got one, the normal way of trading. What we do is we look for something called a momentum candle. So that's a large bodied candle in a downtrend where the close is within 20% of the low of the candle. That's the technical definition. So the close has to be within 20% of the low of the candle, and the body of the candle has to be at least 50% of the overall range. So essentially what you're looking for in a downtrend is you're looking for a big bodied candle where the close is pretty close to the low. In an uptrend, it would be the opposite. So you want a big bodied candle where the close is somewhere close to the high, within 20% of the high. Okay? So once you get that, that serves as your signal candle, and then you would get in on a break of a low of that candle. So for example, if we zoom into this over here, this would be a signal candle. This would be the low that I would sell through. In terms of your stop loss, we use something called a 2-bar high or a 2-bar low. So if this is my signal candle, that's my candle number 1. I count back one more, so that becomes number 2. My stop loss goes above there. Why do we do this? Why do we not place it above the highs? Well, there are 2 reasons. First of all, my data has shown that generally speaking, if the market breaks my 2-bar high, it's likely going to take out the ultimate high anyway. So it allows me to bring in my stop loss closer, which allows me to trade with a larger position size. Okay. The second thing is that as I get opportunities further down, so here's an opportunity to sell. Okay. There's an opportunity. There's an opportunity. We get over here. Here's an opportunity. Great example is this one over here. What I don't want to do is I don't want to keep increasing the distance between my entry to my stop loss. So if my stop loss was above the high, here it will be a fair distance, there it will be a fair distance. And then as I go further down, if I'm using the high, I then need the market to go that much further in order for me to be able to make money. We don't want to do that. We want to be in and out of the markets. We want to, sometimes we'll be in for a few days. Sometimes it could be even be a couple of weeks that you can be in a trade, but you want to try your best not to do it. So I don't want to get into a trade over here, have my stop loss over here, and then in order to be able to go for a 1-to-1, have to wait until the market gets somewhere around here. Okay, because then my entry has been on the 5th of April. My exit's on the 27th. I'm sat in that for a whole month. Don't want to do that. So it's better to say, okay, well, my entry is going to be here. I'm going to use a two bar high. So that's over there. So then where is it that I'm able to get out? Well, if I get in there and say that's 159 pips, I need to see 159 pips on the downside. It's this candle over here. Now, in this case, it is close enough to where it would have been if it was above the highs. But I think you kind of get the idea. As we move on, and as the market does move, you'll find that you get out quicker and quicker, which will allow you to recycle your money that much faster, put it back into either that pair or put it into another pair. Okay? And that is the approach that I promise you, if you start implementing this, you will make money. There's no doubt about it. The only thing you got to sort of fight your way from is don't try and take every trade. Make sure you wait for that momentum candle. If you wait for that momentum candle and you look at the overall context, so the price is below the 20 period moving average, it's also below the 200 period moving average, then you're a seller. I promise you, you will come out ahead of the game. As I said, last year, the rolling 24, the rolling 12-month strike rate on the major currency pairs currently sits at 74% with this strategy. Okay? So that's my monologue over with. Hopefully that makes sense. What I want to do now is I want to open up the door, or open up the floor rather, to any questions you all may have. Are there any questions by anybody? Does this technique work on gold as well? Yes, it works on everything. You can even use it on equities. You can use it on commodities because it's a price-based strategy. And in terms of where we place our stop loss and things like that, it's dependent on the market. So it's agile in that sense. Can you use it below the 4-hour time frame? You can, Press. You absolutely can. You have to understand that your win rate won't be as high. And really, you don't need to, if I'm honest. If you trade this on the daily, just expand your, the overall currency pairs that you trade, or go into other assets, include equities, include commodities and things like that. Can I repeat how to determine a momentum candle? Yes, absolutely. So if you want to write this down, a momentum candle, so a bearish momentum candle is a candle where the body is at least 50% of the overall range. So let's say the range of the candle is 100 pips, okay? The body would need to be 51 pips. Then the close would need to be within 20% of the low. So if the low is at 0, you wouldn't want the close to be anywhere above 20. You'd want it to be somewhere between, 0 and 20. A bullish momentum candle is the same in terms of the range. So you've got 50% of the overall range of the candle. And then the close needs to be within 20% of the high of that candle. Does that make sense, Freddie? And I know that this seems oversimple. I do. And I realize that some of you will be looking at this thinking, oh, I've seen some incarnation of this on the internet somewhere. And if you have, fantastic, wonderful. But why haven't you put it to work? Because this makes money. There is absolutely no doubt about that. I actually taught this to a community back in September, and the results were phenomenal. You had people doing double-digit returns in their very first month of trading this particular strategy. So it is very simple, but it doesn't need to be complicated. It's only, the Instagram heroes and things like that that feel that they need to justify, their fees and things that try to make things overcomplicated. You don't need to do that. You can actually trade as simply as this and you can make money. How long should the target to hold if we trade in the daily chart? Jay, so it will be 1-to-1. So if your stop loss is 100 pips, your target will be 100 pips. Okay. The idea here is that you're in and you're out of the market fairly quickly. You're not trying to hit those home runs. You're just trying to make sure that actually you're putting money into your trading account. You're taking money out of your trading account rather. You're not putting money into it. That's the position that we want to be in. Once you've got that, then you can look at being more sophisticated. So you can develop your fundamental bias. You can run trades for a little bit longer than the 1-to-1. If you have a strong view on the overall direction of the markets. But in the beginning, let's just focus on getting you to a point where you're making money from your trading, which will put you ahead of 90% of everybody else out there. And then once you're making money, then we can look at increasing your profitability through a larger reward to risk ratio, through perhaps a little bit more aggressive setups and things. But in the beginning, make money. Make money, make money. Because that's what you're here to do. And it's very, very possible. Okay. And it's simpler than you think it should be. Can I show you an example of a momentum candle? Yeah, absolutely. So if we look at this downwards move here, okay. This is a momentum candle. I'll just highlight the lows. This is a momentum candle. This is one. This is one over here, as is this. This one, the close is too far away from the low, as is the same with that one there. This one probably is. I haven't calculated it, but from looking at it, probably is. Now the market, wait for the market to go with us. That would be one. That would be one. As would that. And look at the 2-bar stop. So even if you get in at the lows here, our 2-bar stop is just above here. What happens? The market doesn't touch it. Pulls back a little bit, which is normal, but doesn't touch it. And then it goes off and we have momentum candles here. And all of these opportunities would have ended up paying you. They would have made you money. Does that make sense to you, Vivek? Good. Okay, if there are no other questions, then what we can do is we can wrap it up. We've got 5 minutes left on the clock, but if no one has anything to ask. If you have any questions for me, I will type my email address here, so you can just fire me an email. In there, you've got my domain as well. So if you want to head over to the website, you want more tutorials like this, I've got one up at the moment where I walk you through the fundamental process in a little bit more detail. I also give you the framework to my overall strategy. So that might be interesting for you to take a look at. Just go across to the website there on the homepage. There's an opportunity to sign up for something. When you sign up for that, you'll also get some invitation to sort of like some live trading sessions that we can do together. You'll get my analysis as well on a weekly basis, which you might find useful. And then if you want to engage with me from a coaching or something like that, from that perspective, you'll find options there as well. Okay. So I want to thank FX Street for having us all today. Really appreciate all of your time and your effort that you guys and girls put in. I want to thank every single one of you for joining today. Again, I know that your time is very valuable and there are many things that you could be doing with your time. I'm just happy that you came here and you spent it with me. I promise you I haven't wasted your time. This strategy is very, very effective. So do some back testing, prove it to yourself. I promise you, you'll be very, very happy with the results. Okay. Have a wonderful weekend, everybody, and I will speak to you very, very soon. Take care now and speak to you all later.